Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Here is a screenshot of the EUI, which is the euro currency available at ISE. And when I took the screenshot, I was trading around 72. I chose the December month. That's about 47 days to expiration. And as you can see, it uses the simple symbol. It's just whatever the symbol is at ISE, just enter the very same symbol into the TradeKing platform. The left side we have calls, the right side we have puts, and I've only chosen to show the strikes that are in consideration on the put side so that I can keep everything, of a good size for this presentation. In the very next screenshot, I'll show you the calls that I've chosen. The calls in this case are green right now because these are all in the money according to the market data you see. The puts are white because they are out of the money. And what I've chosen here is I've clicked on this white checkbox here once for the 64 puts in December, and that gives me a B in this column here where the arrow is. And then for the sell side, I just click twice for the 68 puts in December, and that gives me the sell indicator. Then I would do the same thing on the call side right here, and I've chosen the 76 calls to sell in December and to buy the 80 calls in December. Now, I'll get into later how I arrived at those particular strikes, but I just wanted to give you an example, just something that you can chew on, if you will. And you can trade this Condor trade directly from the chain. So all you need to do is click, click, click the 4 strikes that you're interested in trading. Use the drop down to choose Condor from the list. And if you're ready to trade, you can go ahead and hit the trade button right here. Or if you'd like to get the math, get the full market quote on that trade, you can also hit get quote instead. And we'll provide you the bid, the ask, and the midpoint so that you know how to put in the appropriate limit price when you enter your order. All right, so for today's discussion, though, I'm going to use a fictitious index called XYZ. And to give you the background information for this trade, it was placed in May, about 50 days prior to expiration. That's why this one here says 51 days to expiration. So I'm using the June series. And at the time, the underlying index was around 735. Okay, here the exact price is 734.49, but let's just call it 735. Excuse me. Now, as I mentioned, you can either do a call condor, a put condor, or an iron condor. These details are here, and you can go into that more carefully and go through the math on your own. All the strike prices are there available for you. If you would like a copy of tonight's slides, please send me an email at webinars@tradeking.com. That's webinars@tradeking.com, and I will be glad to send them over to you. So for tonight, though, what we're going to focus on is the iron condor. And in this case, the strikes I'm using are the 670 puts, the 670 puts, excuse me, the 650 puts, the 670 puts, the 790 calls, and the 810 calls. And all of those are out of the money. So what are we trying to accomplish when we are trading a condor? Like just the real basic crux of what we're trying to do. We're trying to make money, right? That's always what we're trying to do. This is an investment. We're here to make money. We're not here to try things out and see how it goes. I've heard that before, and that always gives me concern. You're here to make money. If you want to try something out, then you can record the trade on paper without actually putting your money into the mix, right? But if you're ready to trade, the reason you're trading is to make money. Well, how can you do that with the iron condor? you need the underlying to go to the sweet spot or the profit area, okay? Well, in this case, that means that the price of $7.35 that we have here, we basically don't want the underlying to really move much from that price, okay? You have some room for it to fluctuate, and that would be between the strike prices of $6.70 and $7.90, but ideally, you really just want it to be between $7.30 and $7.40. If it goes much further outside $7.30 or $7.40, which it likely will do, your level of stress will increase. Why? Because you will start seeing an unrealized loss in your brokerage account, right? You're going to be looking at the prices of where you got into the trade and where the options prices are today, and there's going to be a difference, and it's going to show a loss, right? But you're saying, well, but why, though? I thought you said, Nicole, if it trades between $6.70 and $7.90, that's the sweet spot. That's the profit range of the trade. Well, it is, but that's specifically at expiration, and we are 51 days before expiration, okay? So, yes, you want the underlying to stay between $6.70 and $7.90, but really, to reduce the amount of agita and Alka-Seltzer that you might need, you want to stay between $7.30 and $7.40, $7.20 and $7.50, something to that extent. That doesn't mean it's going to do what you want, but at least you should know what you want it to do before you get into this trade. That's really important. All right, so what if things don't go well, right? There's always a chance of that, and we need to consider where the maximum loss would occur. And that happens as the underlying starts to move away from where it is today, as I just mentioned. But really what you're concerned about is it moving closer and closer and closer to those short strikes, okay? And the more that it moves closer to one of the short strikes, the loss increases. Also, as expiration approaches, okay, it is easier to realize the maximum loss because time is decaying. And even though we want time to pass, right, this is typically associated with a theta-friendly strategy, it really starts to hurt you if the underlying is moving too much. You really just want to stay close to where you started, as I mentioned before. Okay, so as time passes, that loss is going to approach the max if it's moving outside that range that we have predetermined. Okay, the maximum loss will occur at either of the long strikes. So in this case, that was the 650 puts or the 810 calls. And I've also listed the calculations for the actual break-even points, but keep in mind that is expiration. I just want to make one more comment here, and this is a common misconception about trading condors. Okay, as I'm showing you here, you have an out-of-the-money put spread that you're selling and an out-of-the-money call spread that you're selling, right? And that results in a credit on each side of the spread. Some people think that because you can't have both of these spreads going against you at the same time, that you can't lose in the iron condor, okay? If you think you can't lose in the iron condor, you need to listen to me right now, okay? This is really, really important. Even though you can make money on, even though you will always be able to make some money on one side of the iron condor, it will not be enough to offset the loss on the losing side of the condor.
Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.